Welcome, everyone, to another installment of Coffee with Carl. Today, I have Dan Sarnowski from Allspring Global. Today, we're going to be talking the fixed income market. And welcome, Dan.
Thanks for having me, Carl.
Perfect. So why don't we jump right into it? Right now, we've seen tremendous amount of volatility, both equity and, fixed income markets, given the interest rate movement and the banking turmoil, recession talk. Why don't you guys give us a little bit of an overview of where you guys see the fixed income market going, opportunities, and how you guys are really positioning into the future.
Yeah, happy to. And there's no doubt that we've seen an exceptional amount of volatility across just about every sort of investable risk market over the last several years. And of course, we're coming off of 2022, which is the worst year on record, really, in most people's professional investing lives. Sure. For fixed income, for most sectors of fixed income. So very, very difficult environment last year. But that really changed the landscape for fixed income coming into 2023 and has already led to, I think, a really different experience for bond investors year to date. And what I mean by that is, last year we saw not just the Fed, but central banks around the world engage in the sharpest, most severe, strongest period of monetary policy tightening in 4 or 5 decades, certainly on a coordinated basis, not just the Fed, but central banks around the world, massively shifting yields, right? We went from a period of basically zero interest rates to seeing yields jump hundreds of basis points or percent, right? 5% on the Fed funds rate here in the US and various fixed income markets around the world. And what that did is really just shift the landscape, really changed the whole game for bond investors. So we went from a period where bond yields had been very low, where earning income was very, very difficult, to an environment where you're seeing yields in fixed income broadly, the highest levels in 10, 15, in some cases 20 years. So you're really now getting paid to invest in fixed income, as opposed to really just sort of eking out little bits of income and benefiting from sort of a long tailwind that we had through the bull market that followed the financial crisis. So that's a pretty different starting point for the question of, do I want to invest? How do I want to invest, right? Do I want to invest in equities, bonds, commercial real estate, hard assets, right? What's my mix? It's just a very different sort of risk return profile today than it was a year ago. So at Allspring, our view is that, that big move up in yields is mostly done, right? We're sort of at that stage now, at least here in the US, where the Fed is sort of fine-tuning where we're going to land from the Fed funds rate on the very front end of the curve. So if you think about it, the last several times the Fed raised rates, the last several periods of tightening, they would do things in sort of 25 basis point increments, or 1/4% at a clip. So you sort of think about that as one rate hike. And we came into last year, in 2022, expecting about 3 rate hikes throughout the year. We got the equivalent of nearly 20 rate hikes in the last year. So we've seen this massive shift higher. And now we're at that point where some people think the Fed is done. Some people think maybe the Fed has 1 or 2 more 25 basis point hikes left. But now we're sort of in that place of, okay, so do you end up at 21 or 22? Again, that's important. It has meaningful impact, but there's no one out there, or we're certainly not, our base case is that we're going to see another 20 hikes, right? So that biggest move higher is done, but that doesn't mean that things can't be volatile. That doesn't mean we aren't seeing rates move around, and we've certainly seen that. I mean, you alluded to the banking crisis that started, the regional banking issues in March. We saw the 2-year Treasury in March drop by its largest amount ever in 1 week. Just boom, huge swings. So the move higher is done, or almost done, but that doesn't mean that things are just totally smooth seas, right? You've still got this choppiness. But in fixed income, you can kind of broadly bucket the risks into interest rate risk, and credit risk. And so if we think that the biggest move higher in interest rates is baked in the cake, right? Even though there's volatility here, we're more comfortable having exposure to interest rate risk now than we were a year ago. And we think you're getting paid more for that risk today than you've gotten in 10 or 15 years. So that's a risk worth having in the portfolio. The benefit of not only higher levels of income is meaningful to portfolio returns, but now you've sort of reinflated the balloon of yield in the portfolio so that if we do get a shock, if you do get a risk-off event, fixed income can serve more as that buffer in the portfolio that investors have traditionally looked for it to serve as a complement to equities and other risk assets. Whereas last year, you were starting with almost no oxygen left in the balloon, and so any sort of shock, it just didn't work the way most investors were expecting fixed income to work. So I think you've got the benefit of higher yields. You've seen the brunt of that move higher. That's a risk we're more comfortable with. But the other side of the equation is credit risk, and that's we talk about it in our world as getting paid spread. It's the additional compensation that an investor should earn for bearing credit risk, right? I can either invest in a treasury with theoretically no credit risk, or if I'm going to buy a corporate bond or something that has credit risk, I should get paid more. I should get a premium. And that premium, that spread, we think today is okay. It's sort of near or right below, right above long-term averages. So you're getting some compensation to take credit risk. But I think the question is, are we in an environment where you should be getting paid average, right? Is the go-forward risk sort of at average levels, or are we above or below that? And in our opinion, our view is that there is more risk out there in the system. There's more risk that things just get a little worse from here before they get marginally better. And so we want to get paid more than average. So between those two sort of big buckets of exposures between rate risk, interest rate risk, and credit risk, this one we are today sort of having more in the portfolio. We're neutral to taking a little bit more. And credit risk, we're trying to be either neutral or modestly underweight, because we think that things will get a little more challenging in the economy, that it'll be a little bit more difficult for corporate America to keep putting up the sort of earnings numbers that it has, and that you should get paid more to take that risk. And once you do, then we'll add credit back to our portfolios. We'll take more of a position there. But today we're being a little bit more cautious here, and we're more comfortable there.
When you guys are thinking about the credit risk, I mean, obviously the concern is over defaults. What do you think is going to really trigger that? Just the actual recession really coming forward? Because right now, I mean, the economy is still running pretty strong. So are you guys looking at more from that perspective? Or are you guys, looking at it more from something like a one-off scenario, like a bank run that we had, I guess a month or so ago with a lot of the financial institutions?
Yeah, great question. Yeah, it's not our base case that we're sort of expecting another sort of sharp one-off, sort of black swan event. Those happen more frequently than anyone would like to admit. And there's always the possibility that something that no one is talking about or thinking about today is the only thing we'll all be talking and thinking about 6 months, 9 months, 2 years from now. So that sort of shock is always a possibility. But our expectation is more that you should just see sort of a general widening in that spread compensation, because things are going to get sort of generally worse or a bit unevenly worse over time. Some of that is driven by the expectation that default rates probably will rise. It'd be hard for them not to. Defaults were basically zero a year and a half ago. So they sort of only had one way to go. And while the huge increase in yields by the Fed is great if you're a saver, if you're using income, it's very problematic if you're a borrower. And if you raise the cost of borrowing, if you raise the cost of credit by 500 basis points or 5% in a very short period of time, in an economy like the US, where credit is the lifeblood of our economy, we think that's going to cause challenges. It doesn't have to all happen at once. It doesn't mean the whole economy has to fall out of bed, but it does mean that for different issuers and different corporate entities, that cost of borrowing is going to have impact on their results, and that you should get paid commensurately, right? If there's sort of weaker players out there, you should get paid more to invest in them, we think, than you're getting paid today.
And I know we probably will lead into this. When I'm thinking about, big potential events that could come up in the future, I know there's a lot of talk about the real estate market and the exposure to banks. Are you guys already starting to think about, how do you guys position portfolios? That may be a year from now, it may never happen, but obviously a lot of these buildings are very underwater, and that could potentially create a lot of pain for the banking, system. So how do you guys, plan around that?
Yeah, that's certainly one of the risks that I think everyone agrees is out there and brewing, right? Because you have seen a pretty fundamental shift in usage and in support for certain areas of the commercial real estate market, primarily in office.
Yep.
But I think first and foremost, it's also important to remember that the sort of transition in office space started before the pandemic. Right. This was a process that many companies, government agencies, municipalities were going through to sort of say how we can and do work is changing. Remote work didn't just start in 2020, right? People had been working remote. People had been traveling. You're moving to sort of a more hybrid model or office space that's more modular, so that instead of having 10 offices in a city, an organization might have 2 and people can sort of come and go. So those things were already in place. Certainly the pandemic has accelerated that. And there certainly were players that maybe weren't on that wave that were sort of thrust upon it by the pandemic and the work from home and the remote work phenomenon. But we think that, so it's not new, it's been accelerated. So careful credit work should be able to help us find properties and CMBS, commercial mortgage-backed securities, that we think are in great shape. There are certainly marquee properties. There are great offices around, in every city in the country where, you're going to have no problem finding tenants and filling the building, and they've got great amenities, and it's state of the art, and it's been remodeled, and you're happy to go to work. Maybe you don't go 5 days a week right now, but over time, maybe that changes.
Yeah.
But there are probably properties that haven't had the level of investment, that are a little older, that are a little weaker, that they're in, areas or neighborhoods where maybe there hasn't been as much investment. And so I do think there's going to be challenges in the commercial real estate sector broadly. I think CMBS in general is an area where you want to be cautious. Yep. But that's one of the great benefits, I think, that active management and fixed income investors like us and our peers can really add value in, because we can do that credit work and look through to sort of understand which properties are we invested in, which ones maybe do we want to avoid. And it's certainly an area where I would not want to sort of just buy a basket or an index or go passive. And to your other question, Carl, I think you're right that the impact of the eventual sort of settling of commercial real estate issues will weigh on regional banks, right? Smaller community regional banks own a disproportionate amount of that paper on their books. Yep. But, the kind of good news there is that there are thousands of smaller and regional banks across the country, about 4,000 banks in the US. And so that risk is diversified. I think there were a few key players that we've already seen have challenges where they had very concentrated customer bases or collateral types that really made them more susceptible to challenges. But your average sort of community bank, may have certain properties on their books that they're going to have to deal with. But I don't think the sort of the most likely outcome is a mass collapse in all at once commercial real estate and office properties that has an immediate sort of massive impact on the banking sector. So again, I think careful credit work, understanding sort of who owns what, where those properties are, what are the obligations to the banks, certainly will provide opportunities for certain banks to do very, very well and certain banks to be more challenged, but probably not in at this point, we don't see it as a near-term systemic event, that we have to kind of come out and really all hands on deck react to as a market. And I think that's going to be a bit of a shift for a lot of investors. because the last several years, the Fed, different regulators have sort of ridden to the rescue much more quickly than they did. If you think about the financial crisis back in 2007, 2008, it took the Fed and Congress and regulators a year and a half to really sort of come to grips with what was happening and come up with responses and formalize support. And in COVID, it was a matter of weeks, days. With some of the regional banking issues that we saw in March, it was over a weekend. You had regulators step in and sort of slap Band-Aids on and guarantee deposits and take forceful action. And so if the Fed is serious that they need to hold rates high for a period of time, and that they know that is going to cause some challenges, they're telling us they're going to let a little bit more of those challenges through. They're going to have to let some weaker players or banks that are more challenged and companies that are more challenged sort of have problems, right? That we're going to see the default rate tick up. We're going to see some banks have issues, but I don't, right now, we don't see it as a level where we're worried that, again, the financial system is going to collapse, or that the Fed and global regulators have to ride to the rescue, immediately drop rates to zero and sort of give us all this emergency support. We've got to get back to a place where there are winners and losers. The rising tide doesn't lift all boats everywhere all the time. And that's why you do need to be more discerning with your investments. And we need to do our work so that we can pick and choose those credits we feel we're getting compensated to take risk. And ones where we think the risk is too high, we avoid or wait till the price gets better.
You hit on one really interesting point, because when we speak to either individual clients or 401k clients, you often see index funds within the 401k chassis for fixed income. And, we're a big proponent of active. Can you walk through, where some of the value adds are? And then as we get into, these situations where you mentioned where the government's not necessarily going to come to help right away, what kind of risk measures that, one might take when they're looking at more of an index in the fixed income space versus that kind of active strategy?
Yeah, I think, in fixed income, just the way the fixed income markets are built, the way that they trade, the way that the indexes themselves are constructed in the fixed income or bond world, I think really sort of skews the game in favor of active management over passive. And here's a real quick sort of example. You look at a large, systemically important bank, since we're talking about banks, such as somebody like JP Morgan. They have one equity, one stock ticker. So if you are questioning whether or not you want to own JP Morgan, you can sort of decide, do I want to own the stock or not? And there's hundreds of sell-side analysts producing research and telling you sort of their opinion on the stock and what the stock is worth and price targets. There's a lot of transparency there in the equity side and the stock side. But JP Morgan may have more than 2,000, sometimes close to 3,000 different fixed income instruments at any given time that are benchmark eligible.
Yeah.
And so if you decide that you want to own JP Morgan and you want to buy their debt, you've got thousands of options as to how you take that, where you take that. What is it on the 3-year spot on the curve or the 10-year spot? Is it fixed rate or floating? Is it in the dollar or the euro, right? There's all these combinations. And there's not hundreds of analysts on every one of those securities kind of spouting their opinion about fair value. So it skews the game in that active managers can pick through all those options and find, fixed income securities that they think are underpriced, that you're getting paid, a disproportionate amount to take that exposure, as opposed to sort of owning a stock or not. So that's one example of many that we could give, where we think that the bond markets by their very nature give us some of that opportunity. Similarly, sometimes it's just not owning something is a huge value add, right? When you buy a passive product, you sort of get the full basket, whether you want it or not. And if you can just sort of look through and say, here are a few that I don't want. We just talked about CMBS or commercial real estate. There might be some properties that maybe are going to have more challenges and you don't want to own. If you can just avoid some of those, that's a big value add, a big addition to the potential for total return for investors, and sort of a mitigation of risk and volatility, which we think is really important. Because when most investors think about fixed income, they think this is more of a conservative portion of their portfolio. They're not looking for mass volatility there. And again, that's why 2022 was so challenging, because that's precisely what happened, right? You had this, again, no air in the balloon, you didn't get the buffer, the massive move higher in rates meant that prices went down. So you sort of had a very, very difficult recipe last year. But now I think that the all-in yields are much more attractive. The opportunity to provide higher levels of income and to act as that buffer against other risks is just much, much higher for fixed income broadly. And so we think there's good opportunity here. But again, I think from our view, the full risk wave, the full cost of what's happened from monetary policy tightening and recessionary risk has not really gone through, right? It hasn't sort of rolled through where you can just sort of throw a dart and you're going to see awesome yields and awesome total returns, because that spread will collapse and your price will go up and you can sort of go to sleep. In fact, I think it's more of a game of there isn't much that's sort of obviously cheap. And so you're sort of picking through what's a way that we can really diversify that portfolio, spread those exposures around, and give ourselves or the portfolio a lot of options. Because after some of those risks go through, right, prices get better for us as buyers, we'd rather just buy then, as opposed to being stuck, with big concentrated bets. So our sort of positioning in portfolios today and what we're watching for is taking advantage of fixed income, being invested. I think being invested in a point where if maybe you were in, a 60-40 or a 70-30 equities to fixed income investor sort of prior to, years ago, this is a good time to get back to those target allocations, because I think fixed income broadly is more attractive now than it has been for many, many years. But taking that diversified approach, having lots of options, lots of exposures is better, in our opinion, than trying to pick one big bet or one sector where you think this is where we're going to hang our hat and where everything's already okay. I think that's going to be key for investors.
So I think you hit on a point here too. So when we're thinking about, just for participants, when they're trying to create targeted allocations and at least a risk profile and return profile, if things go the way you guys are expecting it from potentially some more recessionary headwinds coming up into the latter part of this year, and if interest rates do fall over the next year or two, what would you say to an investor? Hey, in a core fixed income mutual fund that we have, what would your target rates of return be? Like a 6 to 8. How are you guys envisioning that? The reason why I ask is because right now, if you can go and get 4 to 5%, putting it in a 1 year note, that obviously is very attractive. So there's that risk return that I think a lot of folks are struggling with right now.
Yeah, no doubt. I think we always got to be careful about sort of what's the return going to be. But I think if you say yourself, by the way, I should say we're not in the camp that we just expect that rates are going to plummet right away from here, right? The Fed has worked really hard. Global regulators are still working very hard to get rates to a point where they feel that they are restrictive enough, where they've raised the price of borrowing enough that people want to spend less, right? That's how eventually we sort of get inflation to really roll over, is people spending less. The challenge, of course, if they spend too much less, if we stop spending enough, right, we tip ourselves into a recession and they are forced to cut rates. So it's a balancing act, but we do think that the Fed is going to try and hold rates elevated for an extended period of time. So we're not in the camp of, hey, we expect rate cuts by the end of the year, or we expect, Fed funds will be back down to 3% next year. So I don't think that the reason to buy fixed income is to just buy fixed income because yields will fall. I think that feels like a tempting proposition to a lot of investors of, I'll just sort of wait on the sidelines. I'll sit in cash or stable value or a money market fund or deposits because the yields on the front end of the curve are the best I've been able to get in years. And then I'll sort of perfectly time this jump and add some fixed income right before yields fall. And I'll really do that. First of all, the reason and the timing of Fed cuts is very tough to predict. The last several times they've had to cut rates after raising them, it was for things like the pandemic or 9/11 or when and where the housing bubble sort of finally burst. These are not things that you could sort of look ahead and say, all right, next month is when they're going to do it. So it's always easy on a rear view to sort of see it on the timeline. Of
course, yeah.
That was the moment. So I think anyone who's saying, I'm going to make this perfect moment, I'll wait for this Goldilocks period where I can perfectly jump and I'll get this benefit of falling yields, I just think it's really tough to do. I think the data proves out that very few people do that. In fact, if you look at a chart of money market fund assets, the amount of money invested in money market mutual funds over time, right? It's this mountain chart that almost only goes up and is now sitting at an all-time high of about 5.5 trillion dollars. And if you look at if you superimpose on that a chart of or a graph of the Fed funds rate, even when it goes to zero, money fund assets go up. So people are sitting at money market funds, getting the highest level they've been able to get in whatever time period. Rates go to zero, they keep adding more to money market funds. So it's tough to do to get that Goldilocks jump right. Very few people actually do it. And there's a cost before that even happens. And what I mean by that is, while the front end of the curve is undoubtedly the most attractive it has been since 2007, almost every spot on the curve, when we talk about the yield curve, is at or near it's the highest it's been in 10 to 15 years.
Yeah.
So it's not just that, hey, the front end is finally attractive and everything else is about where it's been. Everywhere is more attractive, right? In the last 10 or 12 years, right, since the financial crisis, investors put more than $1 trillion into just the Morningstar core and core plus bond categories. Just those two categories for fixed income got more than $1 trillion of inflows, and all of that at yields lower than what are on offer today. So if you like the 10-year at 2.5%, can I show you a 10-year treasury at 3.8% yield, right? It's just, it's better all in income and more air in the balloon to eventually, if and when yields do come down, give you some of that higher total return. In fact, we look at rates not just on the front end, but across the curve. And in our opinion, the 10-year yield has probably peaked for the cycle. We think it probably hit its highest point last October of 2022. Since then, the 10-year is up almost 7% on a total return basis, whereas a money market fund or very, very front-end treasuries might have returned a little over 3% in that time period. Correct. So even though the yield is higher on the money market fund than the 10-year treasury, because you have gotten some of that pull already, the total return is almost twice as high for having some of that exposure. So I think that's the risk for a lot of investors of, it feels good to sort of sit on the front end. I'm earning a lot of income and I'll make some big move, which is tough to find. They probably won't do it. And they're already experiencing, in our opinion, an opportunity cost of waiting. Now, I will also just add quickly that we also don't think it has to be all or nothing. Cash investors have been so starved for income for so long. This is a great environment for them. Any of us, all of us who have cash needs, who are saving, if you're a corporation and you're using daily flows for, payrolls or sort of day-to-day expenses. If you're just an individual investor like you and me, and you're saving to put a down payment on a car, or you're going to help your kid go to college or make a purchase in the next year, this is a fantastic time to use those sort of front-end cash, money market fund deposits, right? Instruments where you're not taking a lot of risk, but you're finally getting some real income. But for that, those other allocations where I think you could have exposures sort of further out into fixed income, again, I think this is a really attractive time to put some of that to work. And I don't think you need to sort of pick, there's not one spot that's the right spot and everything else is like a bad idea. I think that the good news is here, you can sort of diversify some of those exposures around. So you could keep some in that cash position where you're getting the value, put some on the sort of the front end of the curve, right? Maybe a short-term bond, a 2-year sort of target maturity, put some more a little bit further out, something more intermediate focused on the ag, have some higher quality, right? Whatever's best for your risk return profile. I don't think you need to sort of pick one and sort of cross your fingers. I think this is an environment where you can diversify, and that as yields eventually do normalize, you get the benefit of that shift a couple of different times, a couple of different ways, as opposed to sort of trying to pick one big brave bet. So I think that's a good spot for fixed income investors to be in. But that lull of I'll just get it exactly right and I'll wait. I think a lot of people end up waiting and they end up missing out, and then they just sort of miss out.
Yeah, I mean, it's the same as with equity investors, right? When they're sitting in cash and everyone wants to time, right now, right? There's concern the market could fall. Well, the market's run, pretty tremendously over the last month and a half, and everyone keeps calling for it to come back down, and we keep getting, these little spurts. So, whether fixed income, equity markets, obviously, it's always very difficult to time.
Right.
And I think you also highlight a really important factor is, you may see a 4 or 5% yield on, some total, return bond fund, but when you factor in the excess return, if interest rates do come in, they become even more attractive. So I think that's really important, for investors to remember.
Yeah.
And now you highlighted one area of concern, obviously, is potentially in the risk of credit, but the credit funds out there, a number of them are paying pretty handsome yields. I mean, you may see anywhere from 8 to 10%, if not, more, depending on, what level of risk.
Yep.
How are you guys thinking, with that in mind? Is that an area obviously active is really important specifically there, but is that an area you guys still feel comfortable with? Or is it, you start to go a little bit more underweight for some of those risk measures?
Yeah, it's a great question. Our team manages a really broad set of portfolios and products. One is called our Core Plus Bond Fund. I'll just mention it because it can invest all over the place, right? It can invest in high quality, treasuries, government securities. It can invest in investment grade corporate bonds, high yield, right below investment grade bonds, some of the securities you're talking about. We can invest outside of the United States in European credit and emerging markets, right? So we can take a really broad approach. And that one portfolio kind of gives you an idea of how we're looking at things and feeling about risk in general. And today in that strategy, we are underweight high yield. We're actually also underweight investment grade credit. And the reason is, like I mentioned, we think you are getting paid a lot to be in those positions. The majority, though, of that payment is coming from the yield, the treasury yield component, and the spread. That credit compensation is just a little thin. It's just not super exciting. We have some exposures there, so it's not like we have none, but we're just being underweight and trying to be patient. But the difference about this environment today versus especially the last 10 or 15 years is that that's not the only game in town. And we can diversify some of those exposures out and earn more income today without having to just sort of plug your nose and buy high yield, because that's the highest paying thing. So we can do things like buy foreign treasuries. So like German bonds, French oats, Spanish sovereigns, things that for a long time had actually negative yields, if we can all wrap our arms around that concept, but the yields are now positive. And then when you hedge away the euro currency, so kind of put it back, turn the income back into dollars, the all-in yield there is about 100 basis points more than you can earn in a US Treasury. And so if your options are, I can earn 100 basis points with very little to no credit risk, or I can earn 120 basis points, 1.2% in investment grade corporates, where we think credit risk is likely to increase, right? You kind of have this trade-off where we can put allocations in other pockets or other buckets and still earn a really attractive level of income without having to sort of just, cross your fingers and buy high yields. So we're underweight some of those sectors today. Certainly, as you mentioned, with active management, there are great issuers and names that we really like and have a ton of confidence in. There are ones that we would buy more of if the price got a little cheaper, right? If we just think a little bit more spread, a little bit more compensation, we buy them. But really, it's more around lots of little decisions today as opposed to sort of one chunky allocation. Because again, I think nothing is really obviously already cheap, but as things sort of cheapen up, or as that sort of wave goes through, we should get paid more and we can make some of those trade-offs.
Yeah, I mean, I think you just highlight a really important factor. I very rarely see folks even introduced fixed income in international space, at least when I come across like 401k plans. And, that certainly could be an attractive option for them to review.
Well, you also mentioned, that's another reason for that passive versus active conversation, right? If you're using an index product that tracks one index, like the U.S. Aggregate Bond Index, right? That's an index that is made up primarily of U.S. Treasuries and agencies, some securitized like mortgages and asset backs, and then investment grade credit. And if you, like us, think that investment grade credit is a little expensive, if you're buying the index, you get the index. That's all you get.
Yep.
And if you're in a product that can only invest in those three things, well, then that's what you do. You either own credit and you don't like the price, but you got to own it, or you can underweight it and try to own a little more treasuries or a little bit more, mortgage backs or something. Whereas strategies that have a little bit more flexibility to say, you know what, I'm going to have a couple of % in European investment grade as opposed to the US investment grade, because again, economies are all going through this same kind of phenomenon with inflation and higher rates and a slowdown in economic activity, but they're going through it at different paces, at different magnitudes, with different responses from different regulators. So you get that diversification, and you can just hedge some of those bets a little bit more, which we think is a value add, as opposed to these are my options, or the index is what the index is, and as a passive investor, that's what I get. So I think those little bits are meaningful in an environment like this.
Yeah, no, I 100% agree. And, that's why I wanted you to join us today, because I thought it was really important to be able to unpack I think one of the most core conversations is really active or passive in the fixed income space, because a lot of folks, they hear passive is the best way to go. And they run these studies showing, rates of return, but it's a much different perspective when you're looking at a large cap index versus large cap mutual fund managers, as opposed to getting into the fixed income space where you have thousands of different issuers. Yeah. So, we certainly appreciate you going through today and unpacking this fixed income conversation. And I certainly welcome our partnership and continue to use you guys in the future. So thank you for your time today.
Thanks so much for having me. I appreciated the conversation and look forward to another one in the future.
Appreciate it. Thank you, Danny.
Thanks. Take care.